It feels like we could go either way because it feels like market participants have a bit of fatigue in terms of getting too euphoric or too disappointed by headlines. You say that there's too much negative positioning. What makes you think that we're going to see a breakout from here?
I mean, at the moment, if you look at the markets, it does really feel like positioning is too bearish on the fundamentals at the moment. So I think in the near term, we possibly do have the room for a technical bounce. So if you have a look at, for example, the American Association of Institutional Investors, AAI Bull Index. That index shows that bullish sentiment is near all-time record lows, and we're pretty much at levels that have coincided with a rebound in equities. If you have a look at the semiconductors index, for instance, that's near record highs at the moment. And that index, the semiconductors, are actually outperforming the broader market, and we're poised to break out there. And if you have a look at the commodities front as well at the moment, look at the short interest positioning in copper futures, and they're pretty much near extreme shorts, yet we're not actually seeing copper prices track lower as well. So overall, it does look like that positioning at the moment is tilted too far to one side, too negative. We may have a clean out, and that should be supportive for risk assets in the near term.
Prashant, I find your call on the bond market really interesting because after the brief bounce that we've had, we've gone sort of back to the old playbook, right, which is buying bonds and selling equities. And, I mean, at the end of the day, are we at the very end of this cycle? And is that going to be more of a structural determinant than what happens with any sort of short-term phase one trade deal?
So, yeah, I think near term we can get bonds selling off a little more. If you have a look at the price action around heading into the ECB meeting, positioning had just gotten too long, too far. So we think that we've pretty much got an unwind of that trade to go. Broadly speaking, though, the fundamentals are still supportive for fixed income. Nothing really has materialised on the trade front. We got the agreement to get an agreement, essentially. So it doesn't really look like much has changed there. Structurally, the main issues have not been addressed. We do expect that the Fed will most likely have to cut later on next year as well. So overall, we've got a low growth backdrop, inflation disappointing, and trade flows slowing down at the moment. So overall, it does look like central banks globally are going to have to ease.